This presentation is for Chapter 6, Variable Costing. In Learning Objective 2, we are going to compute operating income using variable and absorption costing. Now that you know how to calculate unit product costs using variable costing and absorption costing, let's look at the effects the two methods have on calculating operating income. There are three different scenarios to consider. 1. The units produced equal units sold. 2. Units produced are more than units sold. And 3. Units produced are less than units sold. Assume that there is no beginning finished goods inventory. If the number of units produced equals the number of units sold, then there is no ending finished goods inventory. When this situation occurs, the operating income under absorption costing equals the operating income under variable costing. This exhibit shows that there is no difference in operating income between the two costing methods. The reason is that all fixed costs are expensed. In other words, because the ending finished goods inventory balance is zero and there are no production costs assigned to the inventory accounts, all costs incurred have been recorded as expenses and deducted from revenues on the income statement. The absorption costing income statement includes all manufacturing costs, direct materials, direct labor, variable and fixed manufacturing overhead. In the cost of goods sold, net sales revenue less cost of goods sold determines gross profit, and then selling and administrative costs, both variable and fixed, are subtracted to determine operating income. In the variable costing income statement, variable costs are reported separately from fixed costs. Variable costs, direct materials, direct labor, variable manufacturing overhead, and variable selling and administrative costs are subtracted from net sales revenue to determine the contribution margin. Fixed costs, both manufacturing and selling and administrative, are then subtracted from contribution margin to determine operating income. Assume that there is no beginning balance in finished goods inventory. If the number of units produced exceeds the number of units sold, then there is an ending balance in finished goods inventory. In this case, operating income under absorption costing will exceed operating income under variable costing. This is because the operating income is more under absorption costing, since some of the fixed manufacturing costs are part of the ending inventory and not yet expensed. With the change in the number of tablets produced, the unit product cost must be recalculated because fixed costs are spread over a greater number of units produced. The calculations are summarized in the exhibit shown on the slide. The increase in production decreased the total unit product cost from $300.50 to $289.40 under absorption costing. The variable costing per unit stayed the same. As shown in this exhibit, when more units are produced than sold, operating income is greater under absorption costing than variable costing. The reason is that with absorption costing, some fixed manufacturing costs remain in ending finished goods inventory on the balance sheet and have not been expensed. The difference between the operating incomes for the two methods is $22,200, $180,200 minus $158,000. This is the difference in ending finished goods inventory, $144,700 minus $122,500. This difference is due to the fixed manufacturing overhead cost. Under variable costing, all of the fixed manufacturing overhead is expensed. Under absorption costing, $22,200, which is equal to 500 units of ending inventory times $44.40 per unit for fixed manufacturing overhead costs, remain in ending inventory and are therefore not expensed in this time period. The $22,200 difference results in the operating income being greater under absorption costing. When the number of units produced is less than the number of units sold, operating income under absorption costing is less than operating income under variable costing. This is the opposite of the situation that we saw previously. With the change in the number of tablets produced, the unit product cost must be recalculated. The calculations are summarized in the exhibit as shown. The decrease in production increased the total unit product cost from $289.40 in the last exhibit to $319 under absorption costing because the total fixed manufacturing overhead costs were distributed among fewer units produced. Again, we see that the per unit product cost under variable costing has stayed the same. This exhibit shows the income statements for Smart Touch Learning for Year 3 under absorption costing and variable costing. When more units are sold than produced, operating income is less under absorption costing. This exhibit summarizes the income statements for the 3 years. In the 3 years illustrated for Smart Touch Learning, the only difference was the number of tablet computers produced in each year, the number of tablets sold, the sales price per unit, the variable cost per unit, and the total fixed costs were the same. In this exhibit, operating income under absorption costing was greater than operating income under variable costing in Year 2 when production exceeded sales. Notice that the 3-year total of operating income is the same under both costing methods. And that is the conclusion of the presentation for Learning Objective 2.